Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
All right, we are back. Episode 125. Carson's Facts versus Feelings. Sonu, I don't know. Hopefully we have something to talk about today. I mean, who knows what's happening by the time people listen to this. We do record this on Tuesday morning, and there's a little bit of red and some fear out there. But this week we're titling the podcast Growth Scare, because there are some big worries about just that, how quickly the economy might be slowing down or might not be slowing down. I'm not sure. But Sonu, I mean, usually we banter in the beginning. I don't know. I just want to get into it. Have you pre-bought anything due to potential tariffs? Isn't that what all these companies are doing? They're just buying stuff now before it gets more expensive?
I was going to be in the market for a car, and now that may be pushed out to, I don't know when it's going to be pushed out. So definitely, I didn't pre-buy the car.
No, you did not.
Can you pre-buy insurance or something? I feel like I should have pre-bought insurance like 5 years ago for the next 15 years of my life or something.
Well, looking back, it would have been a good one to have. Yeah, I mean, we'll get into
all
of
you?
this. Well, I think
I was going to ask if you bought eggs or something. I feel like you should pre-buy eggs now, because I was at the the local grocery store, cleaned out. There were no eggs.
Really?
Nothing. I had to go to another store and pay $5.
Well, I'm a fan of like broaden chocolate milk. I'm telling you, since like the pandemic, you just can't find it. Like sometimes you see it at stores, it's always sold out. So broaden, get your act together, get more chocolate milk out there. But I've been dealing with this for 5 years. I did see like a quarter of all the cars in the United States that we have in the United States are like made in Mexico and made in Canada anymore. So that's kind of everything we're dealing with right now. But let's just dive in, right?
Let's do it.
There's a lot to talk about. Again, we're calling this one Growth Scare, but we'll start with markets as we normally do. S&P gained almost 3% in January, as we talked about. Lost nearly all of that, save for a nice last day of February, which would have been Friday. And then, Sonu, we come in on Monday to the worst day of the year for the stock market, negative on the year. And now, Tuesday morning, who knows where this will be.
Don't say anything yet.
It's ugly. It's ugly early Tuesday. We know why. Tariffs, uncertainty over tariffs. I mean, there's so many ways to take this. But what's your just kind of big picture view, I guess, of how the stock market is performing here so far, really, in 2025?
I mean, it goes back to something we said. Look, there were opportunities and threats, right? At the beginning of the year when we talked about our outlook, the threats are always tariffs. And now it's no longer a threat. I mean, 10 hours ago, we just got 25% tariffs implemented on Canada and Mexico. I don't think anyone, I mean, I'll put myself in the, in this as well. Maybe I was thinking about it the wrong way. I always thought, I was leaning towards the idea that tariffs would be like a negotiating ploy, right? And I didn't honestly think, they would go into place, but they have, and now they're in place, right? You got 10% tariffs on China implemented a month ago, add another 10% on top of it. So this is just forget the tariffs on Mexico and Canada, just the tariffs on China, 20% more is double anything that happened in Trump's first term. Right. Just that. And then you have the Canada-Mexico stuff, right? So that's happened. And we talked about volatility in markets around this. Then on the opportunity side is mostly on the tax policy front, right? And Congress still is not quite getting their act together. Now they may have to even deal with the government shutdown in 10 days. So it's just a sequencing, right? It's all about that. The threats are manifesting sort of before the opportunities arise. So here we have
a government shutdown. We have to talk about that.
No, hopefully not.
Please, no. So on the screen, on the YouTube channel, we're going to share this one, Josh. Chop and frustration is normal. We're going to share that chart. And listen, we get it. The news is out there. The news drives markets. One of the things we've been talking a lot about, I believe, on this very podcast, I know I've talked about this, is early in a post-election year, that first quarter usually isn't all that great. So some chop, some frustration after a 20% gain on the year. Yes, that next year tends to do
25.
Well, yeah, 25 last year. But I'm saying I looked at all the 20% years. There's a good amount of them, by the way. I think 22 or 23 of them since 1950. But the first quarter is kind of choppy and frustrating. So that's fairly normal. And now here we are with this happening. So I'm not saying we didn't expect this necessarily, or we expected this much volatility, but to see some weakness early in a year under some of those scenarios, Sonu, isn't all that abnormal. Now, I'm going to share one more chart, Josh, if you can. The good riddance February, better times could be ahead. This is pure seasonality, yes. As we talked about a lot last time, though, the second half of February isn't all that great. Here's a spoiler alert. The first half of March isn't all that great either. So we're still in that weak seasonal time frame. It's usually the Ides of March when you do better, but these next 3 months, March, April, May, as you can see on the chart we're sharing on the YouTube channel, tend to be some of the stronger seasonal periods during a post-election year. We get it with all the drama over tariffs. Maybe put asterisks up on this stuff, but I think those are some potential positives. I mean, Sonu, let's have some positives. What's a positive thing you're seeing out there? And I guess I'm talking probably more markets than economy right now. We'll get into the economy, the broadening out, the leadership. I don't know. Well, what are some things you see that's maybe a positive for investors out there?
On the positive side, I'm going to couch it as, look, we've been in this camp for a long time. You want to be diversified, not just across stocks and bonds. And, we have gold in our portfolio. We've been open about that, managed features. You want all of that, right? Because you don't know what will zig when stocks zag. And now stocks are definitely zagging a little bit, right? But even within equities, you want to be diversified. You don't want to be, I know you're going to talk about sentiment, but sentiment, you feel like the market goes down 2%, 3%, suddenly sentiment is really bearish, right?
Yes.
And it goes up and suddenly sentiment's really bullish, right? It just goes.
I'll just real fast. I made a joke on Twitter last night, X, we're going to call it, that those AI bears we've been talking a lot about, they're 60%. I said, I bet they go over 100 this week. It was a joke, but you can't go over 100, everybody.
I know.
But yes. Go ahead.
You're levering up bad sentiment, and then you go over 100. But no, that gets to the point. I think a lot of people are concentrated in one particular part of the market. Exactly. You know what part of the market that is? I mean, no secret, right? And that's the part of the market that's been doing well for 2 years. And so when you look at overall valuations,
well, let's just be clear. We're talking large cap tech. Who knows? Compliance, but I like us spelling it out. But exactly. Large cap tech,
right? Everyone's concentrated about that. Everyone's asking about AI, and suddenly you're like, oh, wait a minute, like things are stretched, right? Look, markets are about expectations. Right? You and I always talk about that. It's about what's expected.
Yep.
If you expect growth to be amazing, if it's just short of amazing, not so amazing, but still phenomenally good, that. Markets don't like that, right? And that's what we've seen over this past earnings season. But you didn't have to be that concentrated. You could be, more diversified. And that gets to the positive you're asking about. Yeah. I think momentum has actually done well. It's outperformed in this market. If you look at the S&P 500 momentum index, and what's in that momentum index? That gets to another positive, financials, right? Financials are doing well. I'm not looking at the screen today. I'm ignoring that. That's what's happening in the financial sector. But generally, it's been doing well, right? The financial sector, as of yesterday, this is Monday, March 3rd, it was up about 8% or so year to date, even as the S&P 500 is negative. So there are pockets, there are several sectors that are in the green, right?
Oh, yeah.
And now we'll talk about some defensive sectors, but momentum has mostly, it's not been in tech. Tech has been flat for the last 8 months. Right. Financials have done well. And the other thing about financials is, like, if you look at credit spreads, right? How much more are investors charging companies to borrow relative to treasury bonds, right? And especially the so-called junkiest companies, right? Are you charging a lot more? Usually you do if you're scared about the economy, but right now they're not. The spreads, high yield spreads, are so tight. It's almost like it's bad for investors because there's no opportunity there. You may as well just buy treasuries. Why take any credit risk at all?
Yeah.
But that also tells you that there's no monster under the bed.
Yeah, great points there. So on Monday, when the S&P dropped over 1.7% for the worst day of the year, high yield bonds were down like 21 basis points. I mean, not really by any means a bloodbath. Also, what's the other thing I was going to point out? Oh, the dollar. The U.S. dollar. I mean, use it again. The ETF, don't invest in ETFs, but like the UPP is a UUP.
UUP.
UUP. Apologies, that was down like 1% on Monday. And it kind of history didn't repeat itself. Often rhymes. Mark Twain. It reminded me a little bit, Sonu. I'd love your take on this. We haven't really talked about it, but it reminded me in early August of last year. Yen carry trade unwind. Everyone got freaked out. Believe me, that was a scary 3 or 4 days. Trust me, that was, that was pretty frightening how much the market went down and all the scary news we were told. But you said, listen, the dollar was weak during that sell-off. High yield hung in there relatively okay. We've seen that so far. I don't know what the dollar's doing today on Tuesday, but at least on Monday, that's what we saw. Do you have any takes on some of those things?
Yeah, I think the dollar's slightly down today.
There you go. Okay, slightly lower again. Okay.
Right.
Okay.
And again, the Mexican peso is down, the Canadian dollar is down. Not unexpected, but then Europe is our biggest trading partner in a lot of ways, and the euro is up slightly, maybe against the dollar. No, the dollar hasn't. That tells you that it's a growth scare. I mean, going back to the title of this podcast, right? I think we're going from close to 3% growth to maybe 2%. You could argue, okay, could it be 1.5%? Sure. Could it be 2.2%? Sure. But we are not going to get anywhere close to 3% this year. But that's a big difference, right? Going from 3% to 2%. 2% is basically what we had in the 2010s. It's not a bad environment for profits, for sales growth, right? We saw that over the last decade too. There was no recession, save for COVID. A couple of slowdowns in between. So I think it's just a matter of, it's a re-rating that's a problem, right? Suddenly, people are really optimistic and not so optimistic now. Right. Doesn't mean we're going to a recession. I think we're far away from a recession, right? At least for now. I don't think that at all. I know the tariffs, even with the tariffs going into place, right? These massive tariffs, these are the largest tariffs. The average effective tariff rate for the U.S. is now going to be about 8 to 9%. That is the highest since 1946.
Long time.
That's a big deal. And I still say, no, I still don't see the recession. We can talk about why later when you talk about incomes and things like that. Right. But it's a re-rating, right? Say going from 3% growth to 2%.
No, well said there. Some other things just to think about on the screen now, Josh. We'll put the third year of the bull markets chart right now, but we've talked about this a lot, right? The first 2 years of a bull market tend to be pretty strong because you're coming off of a bear market. You do a pretty good. Third year can be choppy, can be frustrating. We talked about this in our outlook. We pointed this out. Now, yes, we still think stocks are going to do pretty well when all things are said and done this year. Probably double-digit returns. We're reviewing right now. We're overweight equity still. We're going to get more into our models, how we're positioning for volatility, and we've talked about that the last several weeks, actually talking about that. But third year can be frustrating, right? And that's where we are, and that's just something to be aware of. Also, Sonu, this is interesting, I think. Who knows where we'll be by the time people listen to this? But the last 3 trading days, this would be, let's see here, Thursday, Friday, Monday. Okay. Down 1.5%, up 1.5%, then down 1.5%. All right. Okay. And just took a look at that. September of 2020, last time we saw it. But what's interesting to me,
you have something for the months as well, right?
Yeah. Well, let's see. What do you mean by month? Oh,
September, October.
Well, I'll go to that in a second. Yeah, I'll go to that one in a second. But a lot of alternating out there. But when you just have this volatility over 3 days of alternating, like we've seen, happened 19. I can't even remember. This is awfully small. I know. Let me go to one other screen here because I'm having trouble reading it. It's so small on my screen. Here we go. 19 times this has happened, and this is the first time in recent history it happened after we became 500 stocks in 1957. Was 1999. So it didn't happen from 57 to 99, but since 99. It's happened 19 times. 1 month later, up 16 times. That's 84% of the time. That's higher 3.6% on average. A month later, after what we've just seen. A year later, you're talking almost a 21% average return. Again, higher a year later, 84% of the time. Okay, it's just one stat. We get it. But just for everyone to know, you see volatility like this historically kind of closer to potential lows and at major peaks. Now, we've had the sell-off. We're 5% off the highs. Hey, every year on average has about 4 or 5% mini little pullbacks. Well, we've got the first one this year. As we were set up many times, we didn't think this would be the first year in history without any bad news, without any scary headlines, or without any market volatility. And sure enough, we're there. One other thing, Sonu, March is here. March is an okay month historically, but it tends to be more volatile. I mean, who can forget 2023? The regional bank crisis, right? About, if the math is right, 3 years ago right now. Of course, March of 2009, March of 2003. March has been volatile, but we've also had some major lows take place in March in history. Also, we can get into exactly why, or maybe there's no reason. I just rather know than not know.
We had March of 2020. I'm trying to think off the top. March of 2020, March of 2009, right?
And then 2003 were all
2003
major,
too, yeah.
And then, of course, the regional bank crisis. So, but the one you were pointing at, it's 6 months in a row now alternating, right? So I think if the math is right, it's up in September, down in October, up in November, down in December, up in January, down in February. That's like the longest streak we've seen since 2022's bear market. Something to think about there. Last time I saw alternating like that. So again, it's choppy, it's frustrating, maybe. And again, if a lot of the stuff we've talked about, I don't think it's overly surprising that this is choppy and frustrating. But one thing I want to ask you now, Sonu, because I can rant on this all day. You pointed something out I think it's really fascinating. The last 8 months, okay? Now that's ending February, so not counting the first couple of days of March, but ending February. So what is that, like whatever?
Probably makes it even worse once we.
Well, it'd be worse, but tech is flat. Tech is flat, okay, the previous 8 months. Yet the S&P is up 10%. I mean, we hear asked all the time, and I get this all the time by media, can the market hang in there if tech underperforms? Yes, it has been. Now, if tech totally implodes, sure, that's going to hurt the market. But for 8 months, Sonu, tech is flat. The worst sector out of all 11 sectors is tech. And you've got, I hold a financial up 26, 27%. I'm going by memory here. I know it's a lot. It's a lot. You've got a lot of leadership from other areas. So yes, tech doesn't have to lead for the market to do well. We've seen it for the last 8 months. Go ahead and add anything you want to add there.
No, exactly. I think that underlines the point about you don't need tech to outperform. I mean, yes, it'll be nice if you're,
sure,
if the largest stocks in the index do well. That's a tailwind, right? But yeah, the S&P 500 is up 10%. Tech is exactly flat. This is through the end of February. So if you include March 3rd and March 4th, it's going to look even worse, right? Because tech has gotten hammered over the last 2 weeks. But yeah, the financial sector is up 28%. Communication services, I mean, that's kind of tech adjacent. A couple of companies in there that a lot of people think about as tech. That's up 20%. Utilities up 18%. Consumer staples up 10%. Real estate, by the way, because yields have gone down, real estate has been creeping back and doing well, 14%, right? And consumer discretionary up 19%. Industrials also outperformed about 13% relative to the S&P 500's 10% return over the last, 8 months? 8 months, right? Okay. July to December, and then January, February as well. So everything's in the green except tech is flat. Now, after today, tech is going to be maybe energy is struggling in there too, but energy sort of dances to its own tune, right?
It does. Yeah. And OPEC said they're going to produce more oil. That didn't help energy prices on Monday. So, yeah.
Right. Helps the rest of us if you're going to buy, again, gets to the tariff thing, right? Because we get a lot of heavy crude. I mean, this is the question that always comes up that, wait a minute, isn't the U.S. producing more than enough oil to satisfy needs? Yes, in a way, except that you need to refine oil to convert it into gasoline, diesel, things like that. And most of our refineries actually use something called heavy crude. And that heavy crude and all the pipelines feeding these refineries come from Canada, right? What the U.S. produces is something called light sweet crude. I mean, I have no idea why it's sweet and, sour and things like that. Never taste it. But it is what it is. So that's the thing. Like suddenly, wait a minute. 25% tariffs on Canada. By the way, the administration knows this will have an impact. That's why they didn't put 25% tariffs on Canadian energy imports. They put only 10% there, right? So, but then given what just happened with OPEC, to your point about OPEC saying, you know what, we are going to go ahead with production increases, at least no more cuts, right? So that sent the price of oil. I think WTI is close to like 68 or something like that right now. Yeah. So and that's positive from an inflation perspective.
No, well said. Just a couple more things. We probably need to talk about the economy here, but I think we've done a lot on the market. March, the last 4 years, up 4%, up 3%, up 3%, up 3%. The year before, though, was down 12. That was during a 100-year pandemic. Looking at sentiment, there's lots of ways to gauge sentiment. But a few things that caught my attention. The Goldman Sachs is something called their proprietary panic indicator. There you go. The highest since 2022. The CNN Fear and Greed Index, I can only imagine where it is now, but I know late last week it was sub 20. That is consistent with levels you tend to see in bear markets. In the AAII, which again soared from 40 to 60%. Only 60% bears has only happened 6 other times. A year later, stocks up 27% on average, higher every single time. We haven't quite seen put to call ratio spike as much as I'd prefer, but I'll tell you what, the last couple of days that might be happening. I think we saw a lot of put volume on Friday, so that could be starting to happen, which would be one thing that'd be nice. And just the proprietary Carson indicator. We're getting some emails. We're getting some comments. We're getting some requests that when I see some of these, that's kind of thinking, oh, okay, well, we're getting closer to maybe some type of a low with some of the fear that rightfully we're seeing. Because I just turned my head. I got CNBC. It's all red. They talk about the Mexican president here and Europe there. And it is this. The headlines are legit scary. But let's talk about tariffs for a couple more minutes, Sonu, then talk about that growth scare. Well, I know. I mean, it's such a fluid situation. It's happening. The one thing that gets me, though, because we listen, in our outlook, we listed, myself, Barry, the threats. All right, tariffs and the dollar, I believe, were like our two. They were two threats. Now, here's what gets me. One of the things that I said, and I still kind of believe this: if tariffs were truly spiraling out of control, it was a true trade war, I'd expect more strength in the dollar. I'd expect the dollar to be breaking out above previous highs, what was earlier this year. The dollar's not. That's the one thing that's got me a little confused, or maybe not confused, but it's caught my attention, thinking this isn't as bad as everyone's saying. Maybe it's just growth being repriced, like you said, and there's still hope that we get some type of resolution with all this back and forth tariffs. What's your take on tariffs, dollar, or anything else you want to add on tariffs?
So one thing with the dollar. So the dollar actually is up. If you look at the last 3 years, the dollar is actually really elevated still.
That's true. Good point.
It's up 11%. Right? Okay. Now, that's helped get, I know inflation's been relatively high, like 2022. It's come down still. It's been on the higher side, but it would have been worse if the dollar wasn't up as much as it is. Yeah. Right? And now a lot of the gains have come since September, but it's pulled back since September too. So the dollar index rose from September 30th through mid-January, it rose about 10%. I'm looking at it. Since then, it's pulled back 3%. Right. And which kind of makes sense. Look, the dollar ultimately is tied to differential growth rates and expectations, really. How fast are the US growing versus how fast, let's say Europe, because Europe is the euro is the largest part of that dollar index, right? Okay. So let's focus there. Now, up until like 6 weeks ago, everyone was gung-ho, gangbusters. Oh, US economy, 3%. We'll get there, right? Yeah. And, not quite. Right? And everyone was really pessimistic about, European growth and all of that. And now what have we seen over the last 6 weeks? If you just look at something like the City Economic Surprise Index, the US data has been falling below expectations. The European data is coming in above expectations. And then, we won't get into what happened last Friday at the White House. But as a function of that, if you look at the last 2 days, one area of the market, the global equity market that's really done well, European defense stocks, including stocks in defense stocks in Sweden. Sweden actually produces a lot of armaments and things like that. And why? That's because suddenly Europe is realizing that, maybe we have to use more fiscal deficits, or we have to use fiscal spending towards defense, right? So I think that's a boost, and that's a potential boost for the economies. So I think that's kind of keeping the dollar sort of, it's not letting it go much further higher, despite, the tariffs and things like that. Yes, the tariffs have gone into place, 25%, especially Canada and Mexico. At this point, what's unclear to me, Ryan, is that I don't know. Yes, it's, we're going to have negotiations, but it's very unclear what exactly the Trump administration wants. I mean, they've said, we want to control the inflow of fentanyl and drugs across the border. But at the end of the day, you have to put some sort of measurable guidelines, right? Right. Yes, you promised you would do something, Canada and Mexico. But are you actually doing it? Is it verifiable? Is it quantifiable? Right? And there's nothing so far. Maybe something comes out through the negotiations. But at the end of the day, look, none of the stuff helps businesses. We titled our outlook Animal Spirits. Doesn't mean we weren't saying we will get animal spirits, but there was a potential for that. And right now, this sort of stuff sort of kills animal spirits, right? I mean, you look at the ISM PMI data. I mean, we've made fun of it over the years for saying the economy is in a recession or even manufacturing a recession. It clearly wasn't. But still, we want cyclical activity to accelerate, maybe on the back of animal spirits, things like that. We haven't seen that yet. It's still treading water. It's not in a recession by any means. But, the tariff stuff doesn't help. Well, I think that's where the hurt is more than anything else.
No, well said. Let's maybe kind of start to get into the economy and the growth scare. So on the YouTube channel, we're now going to share the Atlanta Fed GDP now, real GDP. Josh, put that one up. I think, Sonu, we've never...
I'm laughing, man.
We've never seen anything like this. I believe it was 2.3% this time a week ago, then dropped to -1.5%, and then at the time we're recording this, what is it, -2?
-2.8.
-2.8. So you're talking, I don't know what that math
Just sit
comes out
with
to.
that for a moment.
5% drop in about a week on the GDP, what they expect the first quarter growth to be. So we can talk a lot about this, but what's going on with that particular thing? Because I don't think the economy truly dropped 5% in the past week. I don't think anybody does.
No, it didn't.
But let's walk some people off the ledge, Sonu. What do you think?
Yeah, so the Atlanta Fed GDP nowcast, -2.8% is where a month ago it was about 2.9%, right? But look, what is a nowcast? It is a running estimate of current quarter's GDP growth. That's what the Atlanta Fed is capturing, right? It's continuously updated based on, the quarterly data that comes in. Obviously, we're fairly early in the quarter. Yes, it's March, but we just about got January data. We haven't even gotten February data. The first February data, actually, we got one data point, which is ISM PMI manufacturing for February. The next one will be this Friday with payrolls, right?
Okay.
We haven't really gotten a lot. By the time we get consumption data, which like retail sales for February, it's going to be mid-March, right? So we still have a lot of time in the quarter left. But that gets to, a particular flaw in the GDP nowcast, right? So that nowcast plunge, it was triggered by this by this advanced estimate of goods trade data for January. Right. So net exports are negative. Generally for GDP, net exports are negative. Why? Because the U.S. imports a lot more than it exports, right?
So, Sonu, you sent a bunch of charts to Josh. Or any of the things you're talking about right now, any of those charts? Or
I'll pull up an export chart, very quickly. But maybe, Josh, you could put up the exports imports.
Well, that's what I'm saying. If you send it to Josh, Josh will pull it up. Yeah.
You can pull it up right now. So, like I said, the U.S. imports a lot more than exports. And now it looks like imports are a drag on GDP. What is GDP? It's household consumption plus business investment, which includes non-residential investment plus housing, right? That's in business investment. Then government. And then net exports. Net exports is exports minus imports, right? Imports are greater than exports, so it's negative. Now, it looks like imports are a drag or subtracting for GDP. But actually, that's not how you should think about it. It's just that, look, if I buy a computer made in China, it doesn't add to U.S. domestic product, right? And it applies to services too. So imports are just subtracting. So if I buy a computer, that's made in China, you don't want to add to GDP. So that's why it's sort of like subtracted. Like, okay, we don't want to count it, right? So the thing is, if imports surge, that means there's actually a lot of domestic demand, right? So that's going to show up in one of three places. It's going to show up as higher consumption, or it's going to show up as higher business investment, or it may show up as an inventory buildup, right? If it doesn't show up, it has to show up somewhere. It doesn't just disappear, right? We're not throwing the stuff into an ocean after importing all the stuff, right? So imports surged in January. It surged in 12%, right? Exports rose just 2%, right? And remember, imports are about 1.5, 2 times exports generally. So the surge in imports means the trade deficit just sort of explodes. The trade deficit rose by about 26% in January. And if you just look at the last 4 months, right, this is something we wrote in the outlook, tying back to the dollar. If the dollar is strong, that's not good for exports. That's not good for U.S. manufacturing. Exports have fallen 1% over the last 4 months. This is October, November, December, and January. Imports have surged 15%. The trade deficit has jumped 40%, right? What's happening? I think the dollar strength has made imports cheaper, exports more expensive. There's been a surge in, you like this, Ryan, gold imports. Maybe a lot of folks over here, they want to buy gold, so they import. I mean, that's why there are gold coins in Costco, for example. A lot of that comes from outside.
You can't even buy those. I mean, they're gone. Like, second they show up at Costco, they're gone.
There you go. I mean, exactly. So, but then gold is actually not counted towards GDP, by the way, right? Because it's not widely consumed or it's not used for production. Then the third one, tying back to tariffs. This is all front running, right? Front running of tariffs. This is not unexpected. And part of it, look, we saw 10% tariffs on Chinese goods a month ago. Now we got the, additional 10% tariffs on China, plus the 25% tariffs. And a month from now, we may see those reciprocal tariffs that we talked about last week, or maybe it's 2 weeks ago. Now I'm losing count.
Right? I'm going to jump in. Sorry, we probably should have put this up, Josh. The subcomponent contributions to GDP now. We want that chart up while we're talking about some of these things.
Yeah, I'll exactly.
Giving Josh trying to give Josh the cues, if you will, when we talk about these things. Yeah.
Right. So here's the thing, right? What we got was this data showing a surge in imports, but we didn't get a surge. Like I said, it doesn't just disappear. It has to show up somewhere else. It didn't show up in consumption. It didn't show up in investment, but it's likely going to show up as an inventory buildup. The problem is we haven't gotten that data yet, right? That data comes, like the trade data is lagging anyway, and the inventory data comes out even after the trade data. So when you have a running total, sort of like you just haven't gotten the numbers yet, and that's why GDP now looks like negative 2.8%. Right. So that's essentially what it is. But I think so if you break down the components, I think that's what, Josh has right now. Breaking down the components of GDP, household consumption, and this gets to January consumption numbers being pretty bad. The Atlanta Fed GDP now is not expecting any contribution from consumption, right? Over the last 2 years, you've gotten close to 2 percentage points of contribution from consumption, right? Now it's saying there's zero contribution from consumption. We'll talk about that. Okay. Business investment and housing also flat. Government spending about 0.3 percentage points. Net exports is expected to drag by negative 3.6 percentage points. Right. Negative, and that's what's driving that GDP nowcast to negative 2.8%. Change in private inventories is just 0.41 percentage points, right? So I think when we get the inventory data, that's going to jump a lot. That's going to offset. Right. Now, the reality is the GDP nowcast is not like the truth or, the one truth or anything like that. It's directionally where things are going. That's how you should use it. I think you should always take the absolute number, whether it's 2.8% or whether it's negative 2.8%, with a lot of bags of salt, let alone grains of salt. But directionally, we know, okay, all the imports that happened in January, and by the way, this is going to happen even in February too, because we are going to get steel and aluminum tariffs. So I think there's going to be front running there, car parts, things like that. There's going to be, when we get the February data, which will be, by the way, in March, right? We're going to see more of this, but it's going to, I think, show up in inventories. So that's essentially what's happening.
Yeah, no, a lot of heavy stuff there. Yes. A lot of heavy stuff there. Our friends at JP Morgan said exports are taking away 3.7%, right? That's what they said. Yeah. That's their data. So, because what's happening, people are front running tariffs. People are buying a lot of stuff, right? I mean, it is what it is. So you see that, but also we've talked before, the consumer, right? Consumption data. We saw consumption data last week, so I know we can put this chart up too, Josh. Which one do we want to do?
The consumption chart.
Consumption pulls back. Yeah, consumption pulls back as goods spending, and this personal consumption was down 0.2% on a real basis. That was negative 0.5%, I believe. One of the lowest numbers we've seen in a while. We said before, it was awfully cold. I don't think I went outside in January as much. I hate to be the guy who says, well, it's just because of the weather. But you've got these odd things where you've got terrible fires taking place out west. Yep. You've got snow all over the place everywhere else. Consumption was a little lower, and is on the screen, that big down yellow bar we're sharing as goods, right? People did not purchase as many goods in January for whatever reason. So, like your take on that. But these are some reasons. The economy's slowing a little bit more. Yeah. It is. But these are some of the reasons why it's not as extreme. And this is a growth scare, maybe a little bit of a growth scare. I don't think it's a major growd scare as of now. But why were goods purchases last month down like we're showing? I mean, I can't quite see it. It's a huge drop, though. Why did that happen?
I mean, if you just think about California, biggest state in the country, probably what, 7th or 8th largest economy in the world?
Yeah, something like that.
There are a lot of fires there. Nobody's buying stuff. Right, its consumption goes down. Right, because suddenly the 7th, 8th largest economy in the world there's not a lot of spending there. But vehicle sales, in real terms, adjusting for inflation, right, fell 6% in January. Okay. Every other major category, look at furnishings, appliances, recreational goods, even groceries, and maybe people are buying less of it, saying I don't know, maybe everyone's on a diet or something. No, only half joking there, but all of these things saw a pullback.
Diet. Well, then again, I was going to make a joke. The diets would have been in January, so I guess that's what data we're talking about. Early
this
in
is
the
January.
Year, by about now, no, the diets are ending. Now that we're in March. Now the sun's coming out. The snow is gone.
We'll get the February rebound. So this is all January data, but good spending in real terms, adjusting for inflation, fell 1.7%. That's 18.4% annualized. That's a big yellow
that's
bar.
Like COVID. That's like COVID stuff, right? I mean, really.
Exactly.
Yeah.
That's all going to come back. I mean, especially when you see numbers that are crazy good or even crazy bad like this, okay, something weird is happening. These should all reverse in February and March, right? So you should get a rebound. By the way, good spending is still 7% above the pre-pandemic trend, even after the drop in January. It's way above. So people are spending a lot more than if you just pull that, 2017, 2018, 2019 trend higher, right? Yeah, we're spending 7% higher than that. So people are still spending a lot. It's just relative to December, they pulled back, right? I think this comes back. I think one small concern is that services spending was only up about 1% annualized. That's the slowest pace in a year. That gets to a third issue. I mean, there's a fires, unseasonably cold weather in the south, but I think there's some seasonal adjustments with the data that is throwing things off. So I think it's a blip. But again, services make up, 45% of GDP? It's almost half of GDP.
Yeah.
That's been running close to 2.93% over the last 2 years, right? Before the pandemic, 2018, 2019, the average is about 2.1%. So services is really what's been keeping the economy running closer to 3%. If that pulls back, I think we have I don't want to say we have a problem, but we just have slower GDP growth, right? So that's something I'm going to be keeping an eye on. But there's good news on the other side when you want to talk about incomes.
Yeah, we'll do that. I mean, so again, just to wrap it up, not to wrap it up, but to summarize some things so far, the economy showing some cracks, yes, but major cracks, not so sure. And when you peel back the onion, there are some reasons why our friends in the Atlanta Fed are saying GDP is just dropping as quickly as it is, because it's kind of the way they compile a lot of the data.
Right.
And a lot of that should come back in a big way, in the future. But incomes matter, and you've been sharing a lot of these. So, Josh, we can share the one that says, what is this?
Disposable income and compensation
growth. We'll share that with the black and the green and I guess that's gold or yellow, one or the other.
Yeah, gold or yellow. I think Carson went gold. Yeah,
I think we'll say gold. Yeah. The reality, yes, inflation is still stubborn, maybe higher than most of us would prefer. Yes. At the same time, real incomes just hit an all-time high. Real wages, real compensation continue to run well above inflation across the board. I mean, Sonu, that still says it's a strong consumer, right?
Yeah, if you think about GDP growth, you and I have talked about this in the past. Generally ignore net exports and inventories. That's a noisy part of this stuff.
That's a motto that I live by. I do not like talking about either of those two things.
Just ignore it, and you'll do well, right? Yeah. Because all we care about at the end of the day is like household spending, business investment, which includes housing too, right? And government spending, right? Whether you like it or not, it is what it is, right? But those are three things that really matter. And most of that is household consumption. Where does consumption come from? Incomes, right? And so far, the labor market is sort of hanging in there. If you look at disposable income, last month, it rose 0.9%. That's 11% annualized, right? Last 3 months, disposable income. So this is aggregate income across everyone in the economy, wages and interest income, dividends, Social Security, and Medicare and Medicaid are in there too. Last 3 months, it rose almost 7% annualized. That's massive, right? Okay. Now, January, it rose because we got some one-time increases. There was a 2.8% increase in Social Security benefits, things like that. Again, that's just to match inflation from last year. The government adjusts benefits higher, right?
Right.
But if and then, I'm sure there'll be folks who are like, wait, you that's just one-off. Yes, it is one-off. But just let's look at employee compensation. Right? Take all the other stuff out. Interest income, dividends, Social Security, Medicare, Medicaid. Take it all out. Just focus on employee compensation. Right? How much are workers earning across the economy? That rose just over 5% annualized pace in January. Over the last 3 months, it's closer to 5.5%, 6%, right? And where was inflation? If you look at headline PCE inflation, personal consumption expenditures index, the Fed's preferred metric, in January, yes, it was a little harder. It was 4% annualized in January, and that's because of energy prices going up. But we just talked about oil prices going down, so hopefully we should see the reverse. Last 3 months, it was up 2.9%. 2.9% last 3 months annualized. Okay. Disposable income was up 6.7%. Employee compensation was up 5.7%. That's a big delta there. That's essentially the speed limit of real GDP growth, like somewhere 2.5%. So there's a lot of income growth there, and that's what sort of tells me that, okay, there's a lot of uncertainty. Maybe you're not getting animal spirits on the business spending, business investment side. But the big part of the economy, which is consumption and incomes drive consumption, that's still holding strong for now.
Wow. Well said. We get some jobs data on Friday, which is probably the big thing this week. So we'll see how the labor market is doing. But before we go further, I want to remind everyone, if you want to hear the latest from us, don't forget to subscribe to our podcast. Get it wherever you get your favorite podcasts. Also, leave a review. We love your feedback. It helps a lot with those algorithms. You can go do some of those things. We appreciate it. Also, facts versus feelings, facts VS versus feelings at carsongroup.com is our email. Feel free and send any questions or comments there. So, we've gone along, and I've got a meeting coming up. Anything else you want to kind of summarize or, I guess, conclude today's 125th episode of Carson's Facts versus Feelings titled Growth Scare? What do you want to say to the listeners before we sign off and ride off into the sunset?
Hey, look, we recognize that there are risks to the outlook. In fact, we wrote about them. Number one being tariffs and the dollar too, right? But at the same time, we're still optimistic. I mean, even our unconstrained tactical models, right, which can go 0 to 100, basically. It's benchmarked to 60-40 portfolio. For the last 2 years, we were closer to 90%. We took that down recently to about, 75-80%. We're still overweight because our benchmark 60%. So we still overweight equities in a big way. But we, you know what? We just had 25% growth in 2023 for markets, another 25% increase in 2024. Yeah, maybe, we still believe in the bull market and we believe in broadening out. We like momentum. We like some low volatility in there too. But, things could be more volatile and be prepared for that.
No, but well said. I mean, we talked a lot about why early in this particular year could be a little dicey, if you will, and then now we've got all the things that are taking place. So yes, we're still bullish, we're still overweight equities, but in the money we run, right, for our Carson partners based in 38 states. Although there's a rumor going around that number is going to jump. Maybe 30, I guess it's going to jump to 39, but who knows? Maybe 40. But there's a state that I might live in that who knows? We'll see.
All right.
There's rumors. You can't trust rumors.
I've always wondered about that. Like, the Buckeye state.
Yeah, we'll see. About time
what's missing there?
I don't know. About time Carson made it there, hopefully. But anyway, so we're growing. If you're a financial advisor out there, want to learn a little bit more about us, go to carsongroup.com. We'd love to talk. But thank you again to all the listeners out there. Things are, I hate to use the word scary because we don't want to come off like we're scared. Like someone said, we're preparing for this. We're changing models. We've owned gold for a while. We added some more gold after the election. We added treasuries late last year. We added some tips about a month ago, maybe, Sonu, give or take.
Just over about 5 weeks ago. Yeah.
I mean, listen, the S&P peaked on February 19th. Okay. That's the peak. And we are adding some treasuries before that. Right. I mean, so, we're kind of getting ready for maybe a little indigestion, maybe is the word. But, for now, at least with all this negativity, our market's all about what's priced in, not priced in, as you exactly said, Sonu, a little bit ago. There's a lot of negativity and all this tariff stuff. It's unfortunate, but the other thing, though, is it can change on a dime. Right? We don't invest on hope. We don't do this based on hope. We're not hoping for that. We're preparing for things with the models we run for our Carson partners at the same time. It can change in a hurry, and we might get some good news as a glass half full type of person. Maybe we get some good news. And don't forget, March has been volatile, but we've all seen some pretty good lows in the month of March. So some things to think about. We have a very special guest next week on the podcast. I'll just give a hint. Think about pie. Think about pie. It's pie day, your favorite pie. So all I'm going to say about our guest. Maybe some people can figure that out, but it'll be great to discuss some things with a really smart person next week on the podcast. We'll see everybody next week. Enjoy. It's March. It's March Madness. Maybe we should have titled this March Madness. It's almost too cliche.
That's still time for that. That's not but spring break couldn't come soon enough, honestly, for me.
What's the old thing? March comes in like a lion. I mean, gee whiz. I mean, every day is like a 1% move one way or the other. So it's coming in like a lion. Maybe it'll leave like a lamb and things will calm down. I think
it's like a Siberian tiger. That's where it's coming.
It's the meanest, hungriest lion I've seen in a long time. So anyway, all right, well, we've gone a little long. I've got a meeting to go. I got to get ready for something here real soon. So with all that, everybody, we'll see you next week. Sonu, sure we'll talk soon. Thanks to Josh, our producer. See everybody soon. Thank you. Take care. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results.
All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.